Hi everyone, this is Matt Curfman with Richmond Brothers here for the Matt's Minutes edition for August of 2019. Well, I guess as the end of the month we came upon Labor Day, and the best word that I could come up with to describe the overall market sentiment in August is it was a blah month. You say blah, well there's a lot that happened, but if you look from the beginning to the end of the month, really the markets didn't do a lot. On average, if you looked at the S&P 500, the Dow Jones, and the NASDAQ, they were on average down 1.1, 1.2% for the month. If I then compare to all of the equities that we manage on behalf of you, this is not indicative of any one of your individual portfolios, but rather all equities in general. We were off around 0.8% when the broad markets are off 1.1. So that's why I say it was kind of a blah month. Now, despite that, I wanted to put some context. When you look year to date, going back to January of 2019 through the end of August, year to date, the markets have done reasonably well. If you remember, we had the market tantrum in the fourth quarter of 2018. But by holding through, that was actually a very good decision for those of you that did. The S&P, the Dow, the NASDAQ, if you look year to date through the end of August, are up an average of around 18 to 18.5%. And again, if I compartmentalize all of the equities that we oversee on behalf of your portfolios year to date, that bucket of equities is up 22.3%. So really good decisions to hang through the roller coaster. We didn't think recession was coming, so we're still seeing a lot of those same trends continue. That said, there were some pretty interesting things that hit the headlines in August, and the biggest one I would say is the inverted yield curve. I'm sure many of you remember seeing those headlines, and there were 2 or 3 days in August where the market dropped quite a bit on the inverted yield curve. Now what that is, the inversion is that if you went out and bought a 2-year treasury bond and you went out and bought a 10-year treasury bond, the 2-year yield, or what you could earn on a 2-year bond, actually exceeded that which you could earn on a 10-year. And so to give you an analogy, if you went to the bank and bought a 2-year CD versus buying a 10-year CD, it would be very normal to expect to get paid more if you locked your money up for 10 years rather than 2 years, but in fact with the bond market the inverse happened. Why is that important? Is historically that has been a recession trigger. Not that the market was going to tip into recession in the next 1, 2, or 3 days, but on average, if you look over the coming 13 to upwards of 19 months, that's typically when the market would peak, and then effectively we would potentially tip into recession historically and statistically. So there's still some breathing room for the markets. It's just a signal that we've already been telling you we think recession could come sometime in the second half of 2020. This is just another key indicator that is reaffirming that thought process we've been talking to you about all year. So the other highlight, of course, continued talk on tariffs and trade wars. Believe it or not, those have been headlines for over a year now. There's been recent discussions that if the current presidential administration does get reelected in the fall of 2020, they're already talking about making it tougher on China at that point. So it doesn't seem like there's going to be a near-term outcome. That said, if there was, that would probably be a surprise in the markets to the positive. So I think that will continue to persist, headlines in the news, and cause a lot of the volatility. We now widely expect, everyone does as well in the fall, interest rate cuts. And so why is the Fed cutting interest rates? We're not seeing the economy grow as fast as it was. And so to give you some context on that, if the economy was growing at 3% annualized per year, and now we're averaging 2.1%, 2.1 is still positive and we're still growing, but not as fast as when it was 3%. So as the Fed looks to basically make money cheap, so if they lower rates again, we're going to earn less as we're used to now on our savings, on our CDs, on our checking and our money markets. Those of you who are borrowers, who have mortgages, car loans, credit cards, typically as the rates come down, led by the Federal Reserve, those loans get cheaper and cheaper, and so you probably will see mortgage rates come down again. So good for those of you who might be refinancing. Our concern is if they keep lowering rates now while the economy is growing, when we do hit recession, the threshold between 0 and wherever the short-term Fed funds rate ends up in the next year, there's not a lot of breathing room for the Fed to keep lowering it below 0 to try to stimulate the economy. So that'll be an interesting dynamic to pay attention to and unfold. The other thing I would just say for now is consumer sentiment still seems to be strong. That's a pretty key indicator in our economy and what we're watching, because if unemployment's low and the consumer feels good, 70% of our economic growth, GDP, is caused through consumer spending patterns. And so when we look at how is the consumer doing financially and feeling, that's another indicator in the near term that although we did have the inverted yield curve, we're not that concerned about the market tipping into recession this week, this month, this quarter. So what does that mean for your portfolio and some of the different holdings, and what are we thinking? As I've continued to profess and talk about throughout every month this year, I think when we continue to get into a position of strength and we see swells in the market, we want to make sure, and whenever appropriate, continue reducing individual equity exposure, but in good price positions. We also want to take some of the things like index funds or broad market holdings, and when they've done well, we want to skim off the top while paying attention to possible capital gains. For those of you with non-qualified joint trust accounts, things of that nature. And then we'll talk about this in our upcoming seminar, but just remember as we get into the last part of the year, on your monthly fidelity statements, if you have non-retirement accounts, so this would be an individual, a TOD, a joint, a trust, typically if you go to page 3 of your fidelity statement that gets published every month, you'll see a category on the left that says realized gains and losses, and you'll see year to date. And that's a number that you want to pay attention to, especially as we get to December 31st, so we can help you be doing proper tax planning if there are questions there. So again, keep skimming from strength, keep shoring up safety nets, and for those of you that draw income, whenever possible, trying to build a higher and higher low duration bond portfolio so that we have between money markets and bonds a forward 12 to 18 months of your draw. And that way we're never in a position where we have to sell stock to fund your draw, if that's possible within your portfolio. So with that, we'll continue monitoring all this, and I don't think we see any major changes to that thought process or that strategy as we head into the month of September. Temperatures in Michigan here are cooling down, so a lot of us here are welcoming the chillier mornings and chillier evenings, and soon to be all the fall colors. We also just wanted to let you know of a few upcoming announcements. One, a lot of you have already signed up for our halftime presentation coming up in early September over at Ella Sharp. For those of you not physically in the area, we'll also have a video recording of that available within a week or so after that session for you to view on your computers or phones as well, so stay tuned for that. And additionally, you're going to see some technology enhancements come out in the near term with an app, enhanced and hopefully simplified performance statements. Monthly snapshots will be uploaded into your portal every month instead of just when you have meetings. And then some changes to your actual investor experience where you are secure document portal, things of that nature. So just be on the lookout for some of those things. And then additionally, while I have you all here and before I signed off, I wanted to introduce you to someone. Recently it was National Dog Day. So one of my dogs, my fluffy children, Parker, came with us to the office to record this, and he has been very nicely sitting right under us without barking. So he wanted to say hi to everyone. Come here, buddy. Come here. You want to say hi? Let's say hi. Say hi, Parker. So this is my 8-year-old little buddy. Thank you so much for tuning in. Thanks for being part of Richmond Brothers, and have a great start to your fall.